Welcome back. In the previous lecture, I introduced the Fed, the FOMC, and the main tools of monetary policy. In this lecture, I'll provide a more in-depth introduction to monetary policy, with a stronger emphasis on economic theory. In the U.S., monetary policy is conducted by the Federal Reserve, the country's central bank, with many important decisions handled by the Federal Open Market Committee, or FOMC. The FOMC consists of 12 members and meets about every 6 weeks. The FOMC handles open market operations, the buying and selling of government securities. Wall Street investors, foreign governments, and interested parties around the world pay close attention to the FOMC's statements released after every meeting. These meeting statements have wide-reaching impacts on the stock market, the bond market, and international trade. Given the power the Fed's decisions have on markets, Fed statements are the most dissected piece of economic news in the world. Recall from the last lecture that the Fed uses 3 tools: the reserve requirement, the discount rate, and open market operations. Legally, the Fed is tasked with a dual mandate, sometimes referred to as the twin goals of monetary policy. The Fed must promote low unemployment and low inflation. You may remember that the business cycle is marked by 2 phases: expansionary phases and contractionary phases. During expansionary phases, economic output rises, unemployment falls, and prices rise. During contractionary phases, economic output falls, unemployment rises, and prices fall. Like fiscal policymakers, the Fed attempts to counteract these business cycle effects. Keep this in mind as we review the Fed's actions over the last 2.5 decades. We'll start in the late 90s. This period, called the dot-com boom, was marked by high economic growth, excessive speculation in the stock market, and a tech bubble that peaked in March of 2000. The Fed counteracted the inflationary pressures of the time by raising interest rates. In a 1996 speech given at the American Enterprise Institute, then Federal Reserve Chair Alan Greenspan famously described the overspeculation of investors as irrational exuberance, and further explained that this behavior results in, quote, unduly escalated asset values, which then become subject to unexpected and prolonged contractions. The subsequent burst of the tech bubble led to a dramatic collapse of tech company stocks and a short recession in 2001. The Fed responded by lowering interest rates in an effort to stimulate employment. With interest rates low and a glut of worldwide savings, investors turned to the U.S. housing market. The housing bubble led to strong economic growth, and the Fed gradually raised interest rates over a period of 2 years, beginning in 2004. In 2007, the housing bubble burst, the stock market crashed, and banks were in big trouble. Economic output fell, unemployment increased significantly, and the economy experienced deflationary pressures. The Fed dropped interest rates to record lows, and for the first time, the Fed engaged in a new form of monetary policy called quantitative easing, a process of adding new money directly into the economy. The first period of quantitative easing, called QE1, occurred from 2008 to 2009. I'll provide a formal definition for quantitative easing and explain how it differs from standard open market operations later in this lecture. In the years that followed, the economic recovery after the Great Recession was slow, with the unemployment rate dropping from 10% in 2009 to 5% in 2015. During this period, the Fed held interest rates at near 0% for about 7 years. From 2016 to 2019, the economy grew and the unemployment rate fell to record lows. Out of concerns of rising inflation, the Fed returned to a policy of raising interest rates. In the beginning of 2020, the economy was strong in January and February, but in March, the world economy suffered blows as a result of the coronavirus. As mentioned in the previous lecture, the Fed used all 3 monetary policy tools in an effort to counteract the economic downturn, indicating just how serious the Fed considers this crisis to be. In addition, Congress rushed to pass a new federal law called the Coronavirus Aid, Relief, and Economic Security Act, or CARES. Signed into law by President Trump, the CARES Act will extend $2 trillion of relief to several groups impacted by the coronavirus pandemic. The act will provide an estimated $560 billion to individuals, $500 billion to big corporations, $377 billion to small businesses, $335.8 billion to state and local governments, and $153.5 billion to hospitals and public health institutions. The Fed loosens monetary policies during times of recessionary concerns and tightens monetary policy during times of inflationary concerns. Loose monetary policy, or expansionary monetary policy, increases the money supply and reduces interest rates, which encourages lending and spending. If effective, expansionary policies increase consumption and investment and increase aggregate demand. Having lowered interest rates on U.S. Treasury securities, the federal government can increase government expenditures since the cost of financing public debts is reduced. The goal of expansionary monetary policy is to lower unemployment and stimulate economic growth in the short run. However, these policies generally lead to higher inflation and a decline in the value of the U.S. dollar in foreign exchange markets. Exports rise as U.S. goods become relatively cheaper to the rest of the world, and net exports also rise. This aggregate supply-aggregate demand model illustrates a recession caused by a negative demand shock. Faced with high unemployment, reduced economic output, and falling prices, suppose that the Fed implements expansionary monetary policy. As a result, consumption and investment rise, and aggregate demand shifts to the right. Tight monetary policy, or contractionary monetary policy, decreases the money supply and increases interest rates, which discourages lending and spending. If effective, contractionary monetary policies decrease consumption and investment and decrease aggregate demand. Also, by increasing interest rates on U.S. Treasury securities, the federal government's cost of borrowing is greater, and so this reduces the amount that the government can spend on other purchases. The goal of contractionary monetary policy is to lower inflation. The economic consequences are higher unemployment and restricted economic growth in the short run. Since these policies reduce inflation, the U.S. dollar appreciates in value, resulting in reduced exports, but increased purchasing power for U.S. citizens that leads to an increase in imports. This ASAD model graphically shows an inflationary growth period, with output above the full employment output and the unemployment rate below the natural rate of unemployment. The Fed is chiefly concerned about rising prices. If the Fed does nothing, the classical model predicts a further increase in the price level as the economy adjusts to long-run equilibrium. Let's suppose that the Fed implements contractionary monetary policy. Higher interest rates reduce consumption and investment, slowing economic growth and shifting aggregate demand to the left. Most importantly, the price level returns to its previous level, and future inflation is averted. The following graph depicts monetary policy in response to a negative supply shock. This is called stagflation, a period marked by both high unemployment and high inflation. If the Fed implements contractionary monetary policy to combat inflation, aggregate demand shifts to the left, reducing the price level, but at the cost of making the recession worse. To avoid the outcome of even lower levels of economic output and even higher rates of unemployment, the Fed may choose to implement expansionary monetary policy. These policies shift aggregate demand to the right, increasing output and decreasing unemployment, but at a cost of even higher inflation. No matter how the Fed responds, it cannot achieve both of its mandated goals. At most, it can achieve just one part of the dual mandate. Let's discuss the difference between the long run and the short run. You may remember that the long-run aggregate supply curve, or LRAS curve, in the ASAD model is vertical and represents economic output at full employment. In the long run, wages and prices are flexible. This theoretical level of output, measured using real GDP, is the size of a country's potential output. That is, a country's level of productive output when resources are used efficiently and everyone who wants a job is able to find one, i.e., cyclical unemployment equals 0%. The determinants of the LRAS curve include the quantity and quality of resources, the state of technology, and the rules of the game. Examples being government policies that encourage new levels of productivity in the long run. The short-run aggregate supply curve, or SRAS curve, is upward sloping due to sticky prices and wages in the short run. Though different schools of thought apply different assumptions about prices in the short run, the classical model assumes that it takes time for workers and firms to renegotiate wages in response to changing rates of inflation. So also, it takes time for firms to create new contracts with suppliers and to form new leases on capital. Increasing or decreasing the money supply can have an effect on short-run economic growth, but it has no effect on real economic growth in the long run. By definition, all prices are variable in the long run. Monetary policy has no effect on the potential amount of goods and services that an economy can produce, just an effect on the number of dollars that are exchanged for those goods and services. A product of the classical theory on long-run supply is the quantity theory of money, originally formulated by the mathematician Nicholas Copernicus in 1517, and later formally developed by economists Milton Friedman and Anna Schwartz in 1963. The quantity theory of money is defined by the equation of exchange, given as M times V equals P times Q. At a given point in time, M is the size of the money supply, V is the velocity of money, P is the general price level, and Q is the quantity of an economy's real output, i.e. real GDP. Recall that aggregate output equals aggregate income. Q equals Y, so Y can be substituted for Q, giving us MV equals P times Y. Note that the right-hand side of the equation of exchange can be written as nominal GDP, since P times Q equals nominal GDP. That is, the current year's price level times real GDP. The velocity of money is the average number of times per year a dollar is spent on goods and services, or the average number of times a dollar changes hands in a given year. Consider a simple example. In a small economy, suppose that the central bank has $100 million in circulation. Assume that the money supply stays constant throughout the year, and that the small economy's nominal GDP is $300 million. How many times would each dollar need to change hands? On average, each dollar would need to change hands 3 times. M equals 100 million times 3, which is the velocity of money, and this equals $300 million, which is our nominal GDP. Velocity changes when the demand for money changes. The demand for money, M superscript D, is the quantity of money that people desire to hold in the form of cash or bank deposits rather than investments. In equilibrium, the demand for money equals the supply of money. M superscript D equals M superscript S. The superscript D denotes demand for, and the superscript S denotes supply of. Consider the following money market graph, with the nominal interest rate I on the y-axis and the quantity of money on the x-axis. Furthermore, it's useful to express the quantity of money in terms of the quantity of goods and services it can buy. This amount, M over P, is called real money balances. Hence, we will define M superscript S as the real money supply and M superscript D as the real money demand using the following equations. The demand for real money equals K times Y, and the supply of real money equals M divided by P. Y is equal to aggregate income, and K is a constant indicating the proportion of income that individuals want to keep on hand. M in this case is an exogenous policy variable chosen by a central bank, assumed to be fixed, and P is the price level as given, which is also exogenous and also assumed to be fixed. As I just stated, in equilibrium, the demand for money equals the supply of money, and both equal M over P. Because real money demand can be written as M over P, we have another way of looking at the equation of exchange. That is, M over P equals K times Y. Here we've just substituted M over P for real money demand, which can be rewritten as M times 1 over K equals P times Y. Notice that this is very similar to the equation of exchange, MV equals P times Y. Since V and 1 over K can be substituted for one another, it is now clear that the velocity of money can be expressed as V equals 1 over K. We refer to K as the money demand parameter, and we can see that V is inversely related to K. When people want to hold a large amount of money as a proportion of income, K is large, and consequently, V is small. As an example, when ATMs were first introduced, people could reduce their average money holdings, and this led to an increase in the velocity of money. Think about it. If withdrawing money from the bank is inconvenient, then individuals will make larger withdrawals on each visit to the bank to minimize the total number of bank visits. From day to day, individuals will tend to carry more cash on hand and consequently keep less money in the bank. And physical cash travels more slowly than digital currency in bank deposits. This makes sense when you consider the way that money travels in a fractional reserve banking system. A large percentage of the money in deposits can be lent out again and is spent more quickly than cash on hand. With one additional assumption, the equation of exchange becomes a useful theory about the effects of monetary policy that economists call the quantity theory of money. To understand the implication of this theory, we'll assume that velocity is constant. As we've just seen, the velocity of money is not actually constant. However, like many assumptions in economics, the assumption of constant velocity is a simplification of reality that provides a useful understanding of the relationship between two variables that we can now identify. With the assumption, the equation can be written as follows: m times fixed v equals p times y. With velocity fixed, a change in m leads to a proportional change in nominal GDP. Real GDP, y, is determined by the factors of production and the production function. Hence, the theory implies that a percentage change in the price level is directly proportional to a percentage change in the money supply. When we consider output to be fixed as well, we obtain the following result: a percentage change in m equals a percentage change in p. Thus, the quantity theory of money states that the central bank, which controls the money supply, has ultimate control over the rate of inflation. Milton Friedman stated that, quote, "Inflation is always and everywhere a monetary phenomenon." Economists have studied the link between growth in the money supply and inflation, and this graph shows the relationship between these two variables. You can see that there is a very strong positive correlation between a country's growth in their money supply and that country's average annual rate of inflation. Friedman further explained that the relationship between growth in money and growth in prices is less close for the short run than for the long run. As we've already learned, short-run increases in the price level can be the result of cost-push inflation caused by temporary shortages of raw materials or increases in the prices of the factors of production caused by events in world markets, and demand-pull inflation caused by dramatic increases in consumer confidence, both of which can be independent of monetary policy. That is not to say that there aren't short-run effects of monetary policy. One such effect is money illusion. When prices and wages rise, individuals can confuse increases in nominal income for increases in real wealth. Suppose that your income rises in the short run. Let's say that you earn 10% more in tips each week as a restaurant server. Initially, you feel wealthier because you have more money, and you decide to treat yourself to a few nice meals and some new clothes. However, you may not realize that your recent increase in nominal wages was the result of widespread inflation that also increased the prices of groceries, gas, school supplies, electronics, and other regular expenses. It turns out that growth in the money supply caused an increase in all prices, and you misperceived that you were wealthier when in fact you really weren't. Monetary policy has other short-run effects too. Consider the fact that wages are sticky in the short run. If your cost of living rises more quickly than your wages, your purchasing power and real wealth are both reduced. You can think of this as a kind of pay cut caused by inflation. Remember from a few lectures ago that shoe leather costs and menu costs are also the result of inflation, even when inflation is expected. It's no secret that economists often disagree on issues of policy. Let's cover a few competing monetary theories from three different schools of thought. Classical economists argue that free markets lead to efficient outcomes and are self-regulating. In macroeconomics, classical economists argue that any deviations from full employment are only temporary. They stress the importance of limiting government intervention in the economy and avoiding fiscal policy. Strict classicalists dispute the need for monetary policy too, arguing that historically, central banks have too frequently made recessions worse and slowed economic growth. Classicalists argue that the most important function of government, perhaps even its sole function, is to promote free enterprise and protect markets from lack of competition. Keynes disagreed. To understand his arguments, let's begin with an example. Suppose that the Fed enacts expansionary monetary policy when interest rates are initially high. The Fed buys bonds and the money supply increases. According to the macroeconomic theory we've learned so far, bond prices will rise and the nominal interest rate will fall. A lower interest rate leads to an increase in investment and consumption that increases aggregate demand, which increases income, output, and employment. Consider the effects of this policy in the corresponding money market graph. Initially, the nominal interest rate is at I sub 0, and when the Fed increases the money supply from MS sub 0 to MS sub 1, the nominal interest rate decreases to I sub 1. A lower interest rate will have a positive effect on spending and investment now that the cost of borrowing is reduced. Keynesian economists have argued that when interest rates fall to very low levels during a recession, people simply hoard money because it's not worth buying or holding bonds that pay so little interest. In the midst of a recession, reduced consumer confidence and reduced business expectations lead to a reluctance to invest. Economists refer to this phenomenon as a liquidity trap. In a liquidity trap, an increase in the money supply is no longer effective in decreasing the nominal interest rate. There is no change in investment, and consequently, no change in income or output. From his work, The General Theory, published in 1936, Keynes wrote, quote, "There is the possibility that after the rate of interest has fallen to a certain level, liquidity preference may become virtually absolute in the sense that almost everyone prefers cash to holding a debt which yields so low a rate of interest. In this event, the monetary authority would have lost effective control over the rate of interest." He further explained that in the U.S. in 1932, there was, quote, "a financial crisis or crisis of liquidation when scarcely anyone could be induced to part with holdings of money on any reasonable terms." Economist James Tobin further elucidated Keynes's arguments regarding liquidity traps. Quote, "The Keynesian trap reflected individuals' preference for holding money rather than long-term bonds. Because of expected future capital losses on the bonds, policymakers could not push bond prices any higher, nor the interest rate any lower. Because expected future bond prices do not move one-to-one with current prices, having been pushed up, they are expected to fall, thus resulting in capital losses." The graph below depicts a money market with a liquidity trap. When the Fed initially increases the money supply from ms sub 0 to ms sub 1, it is effective in lowering the interest rate from I sub 0 to I sub 1. But notice that the new interest rate I sub 1 is very close to 0%, and the demand for money is now flattening out. If the Fed increases the money supply again from ms sub 1 to ms sub 2, it won't have any effect on the nominal interest rate, since the interest rate can't get any lower. In this case, conventional open market operations will have no effect on investment and consumption, and therefore no effect on aggregate demand. While Keynes argued that monetary policy was ineffective at a certain point, Milton Friedman challenged his position, arguing that it is fiscal policy that is ineffective due to the crowding out effect. The monetarist view argues that when the federal government borrows money to finance spending, the increase in demand for loanable funds drives up the real interest rate, depicted in this graph, which crowds out private consumption and investment. Monetarists argue that monetary policy, rather than fiscal policy, should be used to counteract recessionary gaps and inflationary gaps in the business cycle. You now know that when the Fed engages in expansionary monetary policy, it transfers federal funds to banks' reserves, and these funds are created out of thin air. By increasing banks' reserves, banks have more funds to lend. The main goal is to lower the Fed funds rate. The Fed funds rate is the interest rate that banks charge other banks for overnight loans, sometimes referred to as the base interest rate. When a country's base interest rate decreases, it causes the rates banks charge for mortgages and other loans to fall. When interest rates fall, individuals and businesses increase borrowing and spending, and aggregate demand increases. But what if the Fed funds rate is already 0%, or close to 0%, as was the case in the U.S. from January 2009 to December 2015? During this period, the Fed funds rate ranged between 0.07% and 0.24%. At a certain point, the Fed cannot get interest rates any lower. So what did the Fed do? The Fed used a new tool called quantitative easing, or QE. But how is QE different from conventional open market operations? When engaging in conventional open market operations, the FOMC purchases low-risk, short-term U.S. Treasury securities. When engaging in QE, the FOMC purchases longer-term securities and riskier assets, like certain mortgage-backed securities in 2008. Consider the U.S. Treasury yield curve. The orange curve shows a hypothetical yield curve where the effective federal funds rate is already at 0%. The green curve shows a hypothetical yield curve where interest rates on longer-term U.S. Treasury securities are lowered as a result of quantitative easing. The Fed is not trying to lower the Fed funds rate since it's already at 0%. Instead, the Fed is trying to alter the right side of the yield curve. When the Fed uses QE, money is transferred electronically to banks in exchange for financial assets, and this increases the Fed's balance sheets. Compared to conventional open market operations, QE provides banks with a stronger incentive to lend. When the Fed funds rate is already near 0%, banks already borrow at a cheap cost, but the rates they turn around and charge on longer-term loans may still be high. So by increasing the amount of money held by banks and lowering the yield on longer-term financial assets, the Fed uses quantitative easing to encourage banks to lend money directly to businesses and consumers, since the returns on other loans are now reduced, resulting in higher spending and short-term economic growth. In closing, many economists agree that the Fed should focus on stabilizing prices in the long run, while focusing on output and income in the short run. This has led some economists to call for a monetary rule to guide policymakers. A monetary rule keeps the growth of money stocks such as M1 on a steady path, following the equation of exchange to set a long-run path for the economy that keeps inflation in check. As an alternative to setting money growth rules, modern monetary authorities have tried using a simple rule of inflation targeting, which sets targets on the inflation rate, usually around 2% per year. If inflation exceeds the target, the Fed will employ contractionary monetary policy. If inflation falls below the target, the Fed will employ expansionary monetary policy. Note that this target strategy may not work well during negative supply shocks. As we've already seen, implementing contractionary monetary policy to control inflation during stagflationary periods results in lower output and higher unemployment. This wraps up the second lecture on monetary policy. In the next lecture, I'll cover additional macroeconomic principles.